Okay, next we'll move on to C. And let's read C in the adjusting information. The unearned rent account balance is $360 on December 31st, representing the receipt of an advance payment on December 1st of 3 months' rent from tenants. Okay, so what's happened here, you guys? A tenant, let's assume it's one tenant instead of several. Let's say a tenant comes in on December 1st and they say, okay, I'd like to pay 3 months' rent. Here's $360. Now, a couple things come to mind with me. If I'm the landlord and the tenant's offering to pay rent in advance, I'm definitely going to accept it, because later on they might not have the rent to pay, right? Also, $360 for 3 months, $120 a month seems like kind of low rent too. But anyway, those are beside the point. On December 1st, we would increase the cash account with a debit for $360. But you guys, we can't call that $360 rent revenue on December 1st, because remember, to record it as revenue, it has to have been earned. Well, on December 1st, those 3 months, that's December, January, and February. And on December 1st, we haven't earned any of that rent. So instead of placing it in revenue account, rent revenue, on December 1st, instead we credit a liability account called unearned rent. We'll increase its balance. Because there's a future obligation there, right? We either have to let the tenant occupy the space for the next 3 months or give them their money back. So it creates a liability for us on December 1st, unearned rent for $360. And if we look at our unadjusted trial balance, that's the balance we're showing there, right? Unearned rent, $360 on December 31st. But by the end of December, we've now earned a part of that rent. So let's make a calculation over here. Okay, you guys, this is going to seem like overkill, or these calculations will seem like overkill for this one. Really, all you need to remember is we will always make this adjusting entry for the amount of rent earned from the day the payment was received, in this case December 1st, by year end. So in our case, we would have earned a third of the rent by December 31st, or 1 month's worth, which would be $120. But you can use this formula if we have 5 months rent received on November 1st, and year end is January 31st, right? So we'll take $360 rent received, divided by the number of months paid by the tenant, which was 3 months, so that equals $360 divided by 3 months, gets us to $120 rent per month, times the number of months earned by year end. In this case, that's only 1 month. So we'll say 120 times the 1 month gets us, of course, 120. There's the amount for the entry. We always want to make the entry for the amount of rent earned from the day the payment was received to the end of the year. Now, of course, you could just look at this one and figure out 120 is how much we've earned from December 1st to December 31st. But again, this formula will work no matter how many months were received and how many months occurred between the payment date and the end of the year. So we're going to make the entry for 120. And unearned rent, you guys, from our unadjusted trial balance, unearned rent, we're showing it as $360, but we've now earned a portion of that rent, 1/3 of it. So we're going to decrease unearned rent by the 120, the amount earned by the end of the year. So let's go to our journal page. On the 31st, we're going to debit the liability account unearned rent to decrease its balance by 120. Unearned rent has decreased because we've now earned a portion of the rent. Liabilities decrease on the debit side. Okay, it has now been earned, so we can now call it rent revenue. So we're going to credit rent revenue for the same amount, 120. Remember, revenues increase on the credit side. All right, now those are the 3 of your adjusting entries that require a little bit of calculation. The other three are really straightforward. Let's go to D. Okay, on D, it reads fees accrued but unbilled at year end total $500. All right, accrued just means built up. So what's happened here, we have provided service to some customers, maybe on the last couple days of the month, but we're not going to bill for that service provided until January. Well, if we provided the service to the customer in December, then we earned the revenue in December. So we want that to show up on December's financial statements. So we'll get that on the books by debiting accounts receivable for $500. And since the service was provided in December, we earned the revenue in December. So we're going to credit fees earned to increase the balance of the revenue account by $500. We earned the revenue in December. We're not going to bill for it until sometime in January, but we want it to show up on the books in the month that the service was performed, when it was actually earned. So we'll go ahead and put the accounts receivable on the books. It's an asset that increased, and we increase fees earned with a credit. Okay, now the next one is very similar, but it occurs on the expense side. Wages accrued but unpaid at year end total $250. Okay, now here an employee has worked the last few days in December, but they're not going to get paid for that work until sometime in January. But when did their work help us to earn more revenues? Well, I hope you said December, because that's true. Their work in December helped us to earn more revenues in December. So we want that wages expense on the books in December. So to do that, in our adjusting journal entry on the 31st, we're going to debit wages expense to increase the balance of the expense account. Had we paid them, we'd credit cash. But we're not going to pay them until sometime in the new year. So that creates a new liability for us, you guys. This one's called wages payable. Increases on the credit side like all other liabilities. So that's got it on the books. Now the last one's a little bit different. Here we're dealing with depreciation of office equipment for the year totals $50. Now let's talk a little bit about depreciation before we just make this entry. What happens, you guys, they call it office equipment. Let's say it's a copier. Okay, if we buy a copier to use in our business, let's say for $2,000. On the day we buy the copier, we've purchased an asset. But at some point in the future, when the copier breaks down and can no longer be repaired, all the benefit from the copier is now in the past. So the cost of the copier now becomes an expense. And let's say that's 5 years later. But we don't wait, you guys, until year 5 and take the entire $2,000 in cost as an expense. Instead, we would take a portion of its cost as an expense each year that the copier is used. So if we're using it over 5 years and it's a $2,000 copier, we take $4,000 as depreciation expense each year that we use the copier. Because when is the copier helping us to earn more revenues? Well, it's helping us to earn more revenues in years 1, 2, 3, 4, and 5. So we want to take a part of its cost as an expense each year that it's useful to our business. And we'll do that, that's called depreciation. So we'll do that by debiting a new expense account called depreciation expense. It's an expense account, increases on the debit side. And they told us what depreciation of office equipment for the year was $50. So we'll make the entry for that amount. But instead of crediting office equipment, we want to be able to show office equipment on the balance sheet at its original cost, less any depreciation already taken, and then that difference in the two we would call book value. So, instead of crediting equipment, we're going to leave it on the books at cost and credit a contra asset account called accumulated depreciation. Now, asset accounts increase on the debit side. A contra asset will work in the opposite way. It increases on the credit side. I've talked quite a bit about those two accounts here. Of course, depreciation expense would show up on the income statement with all your other expense accounts. Accumulated depreciation would be paired with office equipment on the balance sheet. You guys will get into depreciation much more in a later chapter. Here, all you'll need to be able to do is take that amount and make the entry, like so. But let's look at it a little bit further. The way that would show up, let's say that equipment in question here, let's say we're depreciating at $50 this year, but let's say it cost $1,800. Here's what that would look like on the balance sheet. We would show $1,800 as office equipment. So we would leave it on the books at its original cost. We would show office equipment on the balance sheet at its original cost. Of course, we wouldn't type in original cost, but that's what that number is. Okay, and then if depreciation for the year was $50, we would show that. We'd show that $50 accumulated depreciation as a reduction of the office equipment amount on the balance sheet. And that difference in the two, the $1,750, this is the only amount that would get included in total assets. And we'll call that number book value. So that's the book value for the equipment. Now, if we sold the equipment at the end of the year for $1,775, we'd actually have a gain on the sale of equipment for $25. We'll compute gains and losses based on that book value. The purpose is not to bring it to market value. The purpose is just to take a portion of the cost of the fixed asset as an expense each year that it's used. By doing it this way, you guys were able to show the readers of the financial statements the original cost of the equipment, its accumulated depreciation, and the difference, which we call book value. Now, this would be at the end of year one. If we're depreciating at $50 every year, at the end of year two, accumulated depreciation would be $100, and this would go down to $1,700. But since expenses start each year with a zero balance, depreciation expense in year two would be $50 again. Again, all you'll have to do, though, for depreciation on this test is take the amount here, $50, and be able to make your journal entry here. I just thought I'd give you a little background info on it. And you can read about depreciation in the text. I believe it finishes up on about page 119. It runs about 117 through 119. But you guys, you'll need to be able to make all 6 of these adjusting journal entries. And next we'll look at problem 3.1a, where we'll work through some of these. Thanks.